The US dollar dropped 11% in a year. Headlines are calling it the beginning of the end. 5 data points say otherwise. The dollar is down roughly 11% from January 2025 levels. By currency standards, that's a massive move, especially for the global reserve currency. Gold and silver were going parabolic. The headlines are exactly what you'd expect. Dollar collapse, debasement, end of American dominance. Ben Carlson, one of the most widely read financial writers in the world, just laid out 5 reasons why none of that is happening. First, inflation is under control. The long-run average inflation rate in the United States over the past century is 3.5%. We've been below that figure since October 2023. The initial post-pandemic spike settled in under 3%. This is not the hyperinflation scenario the fearmongers have been warning about. Second, interest rates aren't spiking. The yield curve is steepening, but that's actually a return to normal, long-term yields higher than short-term yields. The 10-year Treasury has been range-bound for years. If faith in America were truly collapsing, yields would scream higher as investors demand a premium to hold treasuries. That's not happening. Third, the stock market remains near all-time highs. The S&P 500 hit 39 new all-time highs last year and has already posted 4 more in 2026. Investors still have plenty of faith in U.S. financial markets. Fourth, foreigners are still buying. Goldman Sachs data shows that foreign investors briefly slowed their purchases of U.S. assets during the Liberation Day tariff shock in April 2025. Then they picked right back up. The U.S. still has the biggest, most liquid financial markets in the world. And fifth, the most important point. The dollar versus a basket of other currencies going back to the early 1970s has seen enormous volatility. Up 50%, down 40%, up again, down again. And the net result over 5 decades is that the dollar is essentially unchanged. All the ups and downs canceled each other out. The dollar was just lower than it is today not that long ago. It's been strong since the end of the great financial crisis. These things are cyclical. Now, there are legitimate reasons the dollar is falling. Countries are hoarding gold, commodities, and supply chain materials because of the trade war. That's real. But what's the alternative to the dollar? Most of the world's debt is priced in dollars. Commodities are priced in dollars. Treasuries are still one of the most liquid bond markets on the planet. US stocks make up roughly 65% of global market cap. Gold and Bitcoin are far too volatile. The yen, the euro, and the yuan aren't up to the challenge. Could the dollar slowly lose its dominance over decades? Sure. Could it happen overnight? Almost impossible. And here's the part most people miss. A weaker dollar is actually a tailwind for diversified investors. If you hold international stocks, a falling dollar boosts your returns. You get the local market performance plus the currency gain. The same dollar decline causing panic in the headlines is quietly powering the best international stock performance in 30 years. Currencies are cyclical. They always have been. The investors who panic at every move lose more than the move itself ever cost them, because panic leads to selling at the wrong time, abandoning diversification, or piling into fear-driven trades like gold at the top. A disciplined system doesn't react to headlines. It recognizes cycles. It allocates across regimes. And it treats every currency move as data to act on systematically, not a reason to burn down the portfolio. The dollar will go up and down through the years, but the system stays the same.